but we have an inverse relationship that has developed between stocks and the US dollar. I don't know how long this will last, but it's part of the new normal that we've seen since approximately 2002. The black line represents the S&P 500. This chart goes back to August, so let's update it for you. The green line represents the dollar index, and you can basically see that they have been moving in opposite directions. The dollar peaked in the spring of 2009, coinciding with the beginning of this latest stock market rally. And there's only one area on this chart where the relationship has kind of broken down, that little yellow zone. During the spring of 2010, there was a small euro crisis at that specific time. It's important to be aware of this point.
Hello, traders! Welcome to this special show. Today, we are doing something different. Today, we aren't intervening a guest. Today, we are honoring a legend. On February 7th, the global financial community lost a giant. At a 3 years old, John Murphy passed away. Let me be clear, if you ever drawn a trend line, if you ever look at volume or used a moving average crossover to make a decision in the market, you owe a massive thank you to John Murphy. He was a pioneer. For many of us, he is the true father of modern technology. Before the internet democratized information, Wall Street was a closed club. John was the man who broke those walls down. But before he was a global icon on television, he was actually a student of another market legend, the godfather of technology himself, and my friend, Ralph Campora. Back in the early 70s, the original MTA, which is now the CMT Association, was an incredible exclusive club. It started with only 18 Wall Street professionals, and the strict rule was that you could only join if you wrote a daily market letter for a brokerage firm. Joe Murphy wanted to join, but he didn't write a market letter at that time. His talent and passion for the craft were so undeniable that Rolf and the founders literally had to rewrite the MTA's constitution just to let him in. That's the kind of paradigm shift impact John had from the very beginning. Later, as the resident technical analyst for CNBC for years, he brought the same shot reading right into the living rooms of millions of people. He wrote the absolute Bible of our industry, technical analysis of the financial markets. He didn't sell magic setups or overnight riches. He proved with decades of data impeccable teaching that human behavior, our fear, our greed, leaves clear, readable footprints on the charts. He taught the world the actual language of the market. For me personally, and for all of us at Trader Brazil, John Murphy was more than just a reference. When I set out to write my own book, Análise Técnica dos Mercados Financeiros e Análise Técnica Clássica, I looked directly to the American master for inspiration. What had happened next became one of the proudest moments of my life and a milestone for financial education in Brazil. John Murphy accepted my invitation to write the appendix for my book. To have the greatest living legend of technical analysis endorse a Brazilian book wasn't just a personal honor, it was his stamp of approval that our market had reached a standard of global excellence. And of course, I must also thank my great friend Greg Morris, who introduced him to us, and Greg that wrote my prologue, and Joe wrote the appendix, and also my friend Buff Dormeyer. This year, as we celebrate the 25th anniversary of Trade Brazil, we know exactly how to honor his legacy. We are going back to 2011, that year for the inauguration of the ABTA Brazilian chapter at our Trade Brazil Day. John delivered an absolute masterclass on intermarket analysis. In this masterclass, John Murphy breaks down his legendary framework of intermarket analysis, the ultimate secret to track the global flow of funds. Think of the financial market as a giant interconnected web. Money hardly just disappears, it rotates. When billions of dollars flow out of bonds, where do they go? When commodities spike, what happens to the US dollar? Murph teaches you how to stop looking at a chart in isolated vacuum and start reading the invisible strings that connect equities, currencies, commodities, and bonds. It's about following the footprints of the smart money as it shifts between asset classes, giving you the power to anticipate the next massive market move before the rest of the crowd even sees it coming. Today, we are broadcasting that historic session so that his legacy remains alive and available forever 21. Before I begin, a couple of important notes. First, a massive and heartfelt thank you to the MTA, now the CMT Association, for making this historic video available to us in 2011. Second, I want to be completely transparent with you to bring this presentation to life in a modern format. We haven't taken the respectful liberty of using an AI generated visual representation of John. However, the voice you are about to hear is 100% original and fully remastered. The voice is his, the brilliance is his, and the teachings are eternal. The CMT community and traders across the globe are in mourning, but the shots keep move to the right. And the knowledge that John left us guarantees that we'll never trade in the dark again. Rest in peace, Master John Murphy.
Hello, I'm John Murphy, today represented by an AI for a tribute from traders of the world to my work and legacy. For those who don't know me, I was Chief Technical Analyst at StockCharts.com and a former technical analyst for the TV channel CNBC. I was also a proud Associate Chartered Market Technician, CMT, the highest global certification in the field of financial technical analysis. I was also the author of the best-selling book, Technical Analysis of the Financial Markets, among others. I hope you enjoy the program and don't forget to subscribe, like, and share. Flavio, back with you.
So here's the plan. Grab your coffee, make it a double, and focus. Because today's episode is going to completely rewire how you look at the markets. Strap in because right after the break, we are opening the ultimate playbook from the father of modern technology, John Murphy. We are going to find out exactly different asset classes are secretly connected and how mastering intermarket analysis gives you the ultimate institutional edge. You cannot afford to miss this historic broadcast. Grab your notebooks. Let's listen to the master carefully. Enjoy the show.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
I'd like to thank everyone for logging in today. Actually, well, the title of my talk, as you can see, is Intermarket Analysis has become an indispensable part of technical analysis. And what I hope to do today is a couple of things. One is to discuss some of the things that may have changed a little bit over the last few years, which I call the new normal. But also, a secondary message, and maybe even more important, is to show you how you can blend into market principles in with a traditional technical analysis, which is the way that I think you have to do it. But before we get to that, we'll show you some charts and explain, how I go about combining intermarket principles with the traditional technical work. I hope you enjoy this lecture as much as I enjoyed giving it at the time. I'd like to just explain what I mean by the new normal in intermarket relationships. Although most of the intermarket linkages that I've written about last decade or two have held quite firm, and most of them are still quite reliable, there are a couple of changes that have taken place over the last decade which you should be aware of. One of them, probably the most important, is that bonds and stocks now trend inversely. When I first wrote my first book back in the 90s, one of the things that had existed for decades was that bonds and stocks moved in the same direction. They decoupled during 1998. I wrote about that in my last book, 2004, and I explained that I thought that was a result of deflationary pressures that began with the Asian currency crisis in 1998. And ever since then, bond and stock prices have moved in opposite directions. And we have seen no sign of that changing. So that is probably the most important change we're going to look at. And the other one is that stocks and commodities have become very closely correlated. That is, we've seen that especially since 2008, after the housing crisis and the financial meltdown of 2008, which I happen to think was the second major deflationary event of the last decade. And I think that's one of the reasons why stocks and commodities have become so closely linked. That has a lot of forecasting benefits to it, which I'll talk about that as we go along. But as I mentioned, you have to go back to the 1930s to find the last time that we saw these kinds of relationships. So I've been using a deflationary model for the last decade. And I think if you do that, then these changes make a lot more sense. Now, let me talk about this changing link between bonds and stocks, because you really have to appreciate this in order to understand what's going on in the current markets. The slide that you're looking at now compare as bond yields, that's the green line. These are yields we're talking about now, not prices. These are bond yields going back from 1993 to about 2003. And that line in the middle, that's right around 1998 during the Asian currency crisis and the year after it when things really started to change. So I'll stop here and let's go back to my 2011 lecture.
The traditional, or the old normal as I now call it, that falling bond yields were associated with rising stock prices. In other words, when bond yields, you could see during 1994 and 1995, we had a big blip up in bond yields, stocks corrected. When bond yields turned back down in 1995, stocks turned right back up again. So the old normal was that falling bond yields or rising bond prices was good for the stock market. If you look to the right of the vertical bar, since 1998, everything changes. You'll notice that bond yields and stocks have been moving in the same direction. And that's been the case now for almost 13 years. So in that environment, in this new environment, for as long as it continues, falling bond yields are actually bad for the stock market. So it's very, very important that you understand that. And to show you, first of all, it's not just that bond yields tend to move in the same direction as stocks, but they have a very strong tendency to lead turns in the stock market. And that's what this next chart is meant to show. This also shows how we combine traditional technical work with the stock market. By the way, all these charts were published on stock charts at one time or another. You can see the dates on the upper left. The next few that I'm going to show you were published at the beginning of September. But the two lines on the chart, first of all, focus on the black bars. That's the S&P 500. And you can see very clearly the head and shoulders top beginning in February, the last peak forming in July, and then the breaking of the neckline at the beginning of August. Now, obviously, if you're a technical person and you understand what that pattern is, you probably should have known that was a negative pattern. But look at the green line. That's the yield on the 10-year bond. As I mentioned, not only does the yield move in the same direction as stocks, but very often tends to lead the stock market. And you can see the discrepancy between the two lines. The bond yield peaked in February and has been dropping ever since then. In fact,
here we can see that by the time the market formed that June low, you can see that the yields were already trading at a new low for the year. This is one example of, by understanding this one simple intermarket relationship, you can use yields in some cases a confirming indicator, but in many cases a leading indicator for the stock market. And even if you look to the bottom right on the same chart, Notice that stock market rally that we had during August, the traditional summer rally, notice that bond yields did not confirm it. You can see the upper black line there pointing up and the green line pointing down. And I remember using this chart at the time to suggest that August rally in stocks would not last. So it's just an example of, if you understand this link, it has a lot of applications.
The second change was this: stocks and commodities are trending together. And I just threw in that last thing, just like in the deflationary 1930s. You can see the head and shoulders top there quite clearly. The brown line there is the CRB index, and you can see the close correlation between the two. But notice that the peak in the CRB index during May, the CRB and in fact, the oil and silver and markets like that really tumbled. In fact, silver, I don't know if you recall, was testing, I think it was $50 or $50 an ounce, and really tumbled during the early part of May. Given the fact, if you know the two markets are closely correlated, like stocks and commodities, and one of them really starts to tumble like that, commodities, that gives you a pretty good indication that the other one is pretty soon going to follow suit. And you'll see that even during the month of June, the CRB had already fallen to the lowest level in about 5 months. So this was a clear example of knowing that you have two markets that have been very closely correlated, and one of them starts to weaken noticeably during the month of May. That gives you a leading indication that the stock market is going to follow in the same direction. By the way, the indicator that I put along the bottom of these charts is just a correlation coefficient, something that I kind of throw along the bottom just to confirm the fact that when that is above the zero line, that indicates positive correlation. You can see the correlation, although it remained positive throughout the entire period here, it weakened a little bit during the spring when commodities broke down, but you'll see that the correlation strengthened again during August when they both broke down together. So stocks and commodities are very closely linked. In this particular case, we had both bond yields and commodities leading the stock market lower. Now let's move on to another relationship, which is actually about as reliable as you can get. There's no change here. This is the long-term relationship between the dollar and commodities. Of all the relationships that I've studied over the years, this is probably the most consistent, and it's very clear here. The green line there is the U.S. dollar index, which is the dollar versus a basket of 6 foreign currencies, and the brownish line there is the CRB index. And we're only showing this over the last couple of years, but the inverse relationship is quite obvious. For example, you can see the peak in the dollar in June of 2010, that down green arrow coincides almost to the day with the upturn in the CRB index. That's the brownish arrow there. They trended in opposite directions through the second half of 2010, the early part of 2011. Notice to the bottom there, during the beginning of May, that was when the dollar started to bottom. See the up green arrow. That should normally be negative for commodities, and as you can see right on cue, if you look at the down, the brown arrow there, so this is during the month of May. That is the exact point where commodities started to weaken. So that's just another intermarket thing. The peak in the commodities during the month of May was caused by a bottom in the U.S. dollar, and you'll notice that the dollar has been had been basically started to move sideways since the month of May. This chart is still almost a couple of months old now. We'll bring it up to date. But you can see sort of moving sideways in the dollar, but notice the downside correction in commodities. You can clearly see that. So just to back up a little bit, we had a peak in the stock market during May, which was signaled by falling commodities, and falling commodities were signaled by a rising dollar. So obviously they're all closely linked, and my whole premise is that even though we're using traditional technical analysis in all of them, knowing what's going on in the other markets gives you tremendous insight into what's going on in any particular market. And of course, if you look at the correlation coefficient along the bottom, you can see the very negative correlation throughout that period of time. Now, here's a relationship which is sort of new. This is not something that holds up historically, but over the last decade or so, again, maybe it has to do with deflation.
I'm going to take a short break here. I'm not absolutely sure, but we have an inverse relationship that has developed between stocks and the US dollar. I don't know how long this will last, but it's part of the new normal that we've seen since approximately 2002. The black line represents the S&P 500. This chart goes back to August, so let's update it for you. The green line represents the dollar index, and you can basically see that they have been moving in opposite directions. The dollar peaked in the spring of 2009, coinciding with the beginning of this latest stock market rally. And there's only one area on this chart where the relationship has kind of broken down, that little yellow zone. During the spring of 2010, there was a small euro crisis at that specific time. It's important to be aware of this point.
Dollar rallied. It really didn't affect our market that much. It did have a negative impact on foreign markets, but I don't want to get into all that right now. But with that one, I'm going to call it aberration, but with that one exception, you can see clearly the inverse relationship between the two. And you can also see, if you look at the upper right there, you can see the head and shoulders top forming in the stock market. And notice the peak was hit during the month of May, which we've already talked about. Notice that was the exact point where the dollar hit bottom. So the bottom in the dollar and the sideways movement since then coincided very closely with the peaking process in the stock market. So if you're a stock market investor, it's very important that you know what's going on in the dollar, and it's also and of course the dollar has a big impact on commodities. So it's all very circular, but the whole point of it is to show how knowledge of what's going on in other markets helps you in your own traditional chart analysis. Now, this next chart actually carries a couple of messages on it. Let me explain what it is. First of all, the dollar September surge confirmed stock breakdown. The bars there are, of course, the S&P 500. The green line there is the dollar index. There's really two messages on this chart, I guess, which is the reason I put it up here. One was that, you can see clearly if you look at the two arrows to the left, it just shows more clearly that the peak in the stock market at the beginning of May coincided exactly with the bottom in the U.S. dollar. But what I found interesting here was that the stock market broke down during the month of August, the early part of August, as you can see. That purple circle there. That's when the stock market broke down. And for about a month or so, the two markets seemed a little out of sync in the sense that, given the inverse relationship between the two, a breakdown in the stock market should have caused an upturn in the dollar. And for about a month or two, they seemed a little bit out of sync. But you can see during the month of September, that green circle there, the dollar really erupted. And that was really a breakdown in the euro. But the message here is that so the upturn in the dollar confirmed that the breakdown in the stock market was for real. It wasn't just an aberration. But it also, one of the more subtle aspects of intermarket work, if you're a currency trader, for example, and you're trading the dollar, and you have two markets here that are inversely correlated, and you see one of them breaking down during the month of August, that greatly increases the odds that the other one will break out to the upside, although in this case it took about a month. Sometimes it takes longer. But it's just an example of how, if you understand these relationships, the breakdown in the stock market actually was an early warning that the dollar was going to turn up. So if you're a currency trader, activity in the stock market became a very good leading economic indicator, a leading indicator. Now, we're going to come back to that. We're going to come back to the idea of currencies and stocks in a little bit. But I want to change direction here just a little bit, just to show you another area where these intermarket principles become very, very important. And this is sector rotation within the business cycle. This chart here, it's published by Stock Charts. It's actually developed from work published by Sam Stovall at S&P, who's written a lot about sector work. And basically, the point of this is to simply show the red line there is the stock market. The green line is the economy, and of course it shows the stock market leading the economy, which is normally the case. But the real focus here is on the sectors along the top that that at different stages of the business cycle, different sectors show market leadership. In the early stages, for example, cyclicals, consumer cyclicals, technology. But my main focus here is at the top there, that energy. Normally in the latter stages of any kind of an economic cycle or a bull market in stocks, normally basic materials and energy become market leaders. That's usually the result of rising commodity prices. One of the signs that a stock rally is in its very mature stage is when the energy sector is the top performing sector in the stock market, and that was the case earlier this year. The way you can tell that rising energy prices are beginning to hurt the stock market is when we start to see a rotation into defensive groups. And the three in next order are staples, healthcare, and utilities. When we start to see rotation out of energy stocks into staples, healthcare, and utilities, it tells us that the stock market is going through a peaking process. It also tells us a lot of other things. But
Let me show you what happened here in real life. This is a defensive rotation that followed the sectoral model at the top of the market. We're showing the four sectors I mentioned here. These are relative strength lines. The black line, it's not labeled here, so you'll have to trust me, but the black line that runs through the middle is the S&P 500. So we're using that as the zero line. And all of these are ETFs, by the way. I use ETFs for all this work. What we're showing here is the action of these four sectors relative to the stock market, relative to the S&P 500. And you can see right at the beginning of April, first of all, at the beginning of April, you can see that the energy sector was outperforming the stock market. Let's go back.
Stock market, the relative strength line, that's the blue line, was rising. Right around the beginning of April, as you can see that down arrow, that was the first time. Well, actually, it took about a month for us to really see this. But right around the beginning of May, we started to notice that you can just use some trend line analysis, whatever you want, that for the first time in almost a year, that energy stocks were starting to underperform. At the very same time, if you look at the three sectors along the bottom, healthcare, staples, and utilities, those arrows, at the exact point where energy stocks started to lose leadership, these other defensive groups that had been lagging all started to turn. And since then, that has pretty much remained the case. So you can see over the next several months, energy became one of the weakest sectors in the stock market, whereas healthcare, staples, and utilities, in fact, over the last 4 or 5 months, are still the strongest sectors of the stock market. So that tells you two things. One is, and I remember writing an article on this back during the month of April, pointing this out. It tells you two things. First of all, within the stock market, it tells you that it's a good time to start rotating out of energy and some of those economically sensitive stocks into some of the defensive stocks. But the second factor is that it's a negative sign for the stock market, because that type of rotation is a warning that the stock market is going through a peaking process. There's also one other little aspect to it having to do with interest rates. I'll just mention it here, that when interest rates are very low and the stock market starts to weaken, when you have falling bond yields, which was the case at the time, and you have a weakening stock market, investor money tends to move into dividend-paying stocks, and healthcare, staples, and utilities. It just so happens that that was also when the move into dividend-paying stocks began. So it all kind of fit together. But if you just go back to the model and look, energy, when energy, staples, healthcare, and utilities, that's where I'm going back, when they are the top-performing stocks in the market, that's normally a sign that the market's going through a topping process. So I just wanted to point that out. That's just another aspect of intermarket work, and it shows how, by just being aware of some of these principles, it not only tells you where to be in the stock market, but tells you a lot about the stock market itself. Now, I want to move on to global linkages, because these are also extremely important and also tell us a lot about what's going on in U.S. markets. First of all, and I'm sure you're aware of most of these principles. There's nothing really new here. First of all, global stocks are closely correlated. That's I think everyone accepts that. You can look at the chart of global stock markets, and you can hardly tell them apart in most cases. However, also another important thing is the second bullet point there. Commodities are very closely tied to emerging markets. Part of the reason for that is a lot of these emerging markets are exports of commodities. Brazil, for example, Russia is another example of that. So a lot of these commodity markets are very closely tied to Russia, but also China, as you are aware, is the world's biggest importer of commodities. So what happens with China, what happens with Brazil has a tremendous impact on commodity markets, and I'll show you that in a couple of minutes. Another aspect of the dollar is that the direction of the US dollar has a big impact on foreign stocks in the sense that when the dollar is falling, for example, that normally benefits foreign shares. When the dollar is rising, that has a negative impact on foreign shares. So when the dollar is, I'm talking a little bit more from the perspective of an American investor. If the dollar is rising, it's actually beneficial to have more money in the U.S. and less money in foreign shares. And we'll show you some examples of those principles at work. But this next chart here is just meant to show the impact of the dollar on foreign stocks. Now, the green line there, that is the dollar index. Okay, you can see it peaking in 2002, hitting a bottom in 2008, and moving sideways since then. Now, the black line is a ratio, and I use a tremendous amount of ratio work in this type of analysis because we're always looking at relative performance. And what this black line is, it's a ratio of EFI, which is EFI iShares, as you know, Europe, Australasia, and the Far East. It's the benchmark generally used to measure the performance of foreign developed markets. And it's divided by the S&P 500, which we normally use as the U.S. benchmark. The direction of that line tells us whether foreign stocks are doing better or worse than the U.S. They're all going in the same direction, but not necessarily at the same pace. And you'll notice an inverse correlation between the two. It's very clear, very consistent. That since 2000, from the 2002 bottom to the middle of, let's say, the early part of 2008, you'll notice that throughout that entire period when the dollar was falling, foreign stocks did much better than U.S. stocks. That has to do with currency translations and other things. Notice at the exact point where the dollar bottomed in the, let's say, the middle of 2008, the outperformance of foreign stocks ended, and you can see them both moving sideways since then. And to the right in 2011, you can see that foreign stocks are sort of rolling over to the downside here at the same time that the U.S. dollar is starting to bounce. So it's a very important relationship to be aware of, that the direction of the dollar has a tremendous bearing on whether foreign stocks are going to do better or worse than the U.S. market. So it's just another aspect of technical work. This next slide is meant to kind of build on that theme. What I've done here, again, it's ratio work. It's foreign markets. Again, this was done in September, early part of September.
Olá, espero que esteja gostando da entrevista. A Trade Brasil foi eleita por 2 vezes no Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
Headline is foreign markets are leading the U.S. market lower. And what I've done here is the red line is the iShares, emerging market iShares, EEM. That, of course, emerging markets. And the blue line is EFI iShares. Again, that's developed markets. Now, these are relative strength lines. These are being measured relative to the S&P 500. And you'll notice that right around the fourth quarter of last year, both groups started to underperform the U.S. market. Part of that had to do with emerging markets raising interest rates. I mean, there are probably other factors involved, but I think part of this underperformance of foreign shares throughout most of this year also has something to do with the fact that the dollar has been moving up throughout most of this year. So it's just another way. And as you're probably aware, emerging markets have been deeply in bear markets. Many of them are down as much as 30% over the last year. Some of the developed markets have been down almost 30%, which is double what losses we saw in the U.S. But I just wanted to point out that it's also very important to know where during a bear market, where most of the weakness is. Clearly over the last year, the U.S. market was a better place to be than foreign markets. And I think part of that has to do with the dollar. Now, this next slide comes back to the idea of emerging markets. Commodities fall with emerging markets, and the correlations here are very clear. So if you're a commodity trader, it's very important that you know what's going on in emerging markets or foreign stocks that are tied to commodities. I mentioned Brazil is one of the world's biggest exporters of commodities, and China is one of the world's biggest importers. And in fact, China buys most of the commodities from Brazil. That's the blue and the red line there. And the black line is the CRB index. And you can see a very close correlation between the two. And you'll notice that right around the spring of this year, again, April and May. And remember that April and May, that's the exact point where the dollar started to rally. You notice the sharp downturn in those foreign ETFs, emerging market ETFs, coinciding exactly with the top in the U.S. dollar. So kind of ramping it up just a little bit, we get a bottom in the dollar the beginning of May. That put downward pressure on the CRB index, but that also coincided with a very sharp downturn in emerging markets. So it's hard to look at one market by itself and really understand what's going on. But the message here is that if you're a commodity trader, for example, you really have to know what's going on in emerging markets. As long as emerging markets stay weak, commodities will probably stay weak. Fortunately, over the last few weeks, we've seen them both bouncing. But anyway, this just shows, the direct correlation between commodities and emerging markets. Now, coming back to the currency markets again, the more developed markets, this chart's a little complicated, so I'll explain what it is. The green line there is simply the euro. This is just kind of the flip side of what we already showed you in the dollar. The green line there, that is the euro, going back to the beginning of the year. And the blue line there is an ETF of European stocks. It's the Europe 350 iShares, which is one of the ETFs that I use. And of course, you can see that there is a close correlation between the two. And you notice they both, European shares and the euro peaked at the beginning of May. And of course, that's when the dollar bottomed. But bear in mind, the euro, by the way, it has something like a 56% weighting in the dollar index. So even though the dollar index includes 6 currencies, it's really dominated by the euro. So the rally in the dollar is really tied more to the collapse in the euro than anything else. But notice here the close correlation between them. Notice the breakdown in European stocks at the beginning of August, which was confirmed a month later by the breakdown in the euro, because we've already covered that. But I want you to notice the line along the bottom. That is, again, a ratio of this European stock iShares divided by the S&P 500. And you can see that since May, but maybe more pronounced since June, European stocks have been falling a lot faster than the U.S. So you have a falling euro, which obviously means a rising dollar. That normally is a bad sign for foreign stocks. And as you can see, European stocks have been leading the U.S. lower since June. The German market, for example, is down something like 30%, 30 to 35%, which is really a pretty bad performance. So a lot of that has to do with the weak euro and the rising dollar. Now for the good news, what I want to do in these last few charts here is kind of bring it up to date and show we've actually seen improvement in these markets since October. I think it was October the 4th when we had an upside reversal day in the stock market. And we've had a nice bounce in stocks since then. And
I want to kind of show how, once again, we're going to use some just traditional technical indicators here in different markets, traditional charts, and show how they kind of all fit together. First of all, I mentioned Germany. Germany is, as you know, Europe has been the real focal point, really driving our market, the US market, markets around the world. And Germany, of course, is the biggest market in Europe. And I'm using the iShares here, Germany iShares. Now, these are weekly bars. And the point I want to make here is you can see the sharp downturn. The chart to the left came right down to its mid 2010 lows. That's a downside target that I've been using for some time, and I guess other chart people have as well. That's a logical spot to expect a market to start to bounce. Let's go back.
Relative Strength Index, or the RSI, and you can see that dipped under 30 where that circle is drawn in. That is also traditionally a very oversold reading. In fact, that's the most oversold reading since the end of 2008. So we had a combination of the German market, which is the dominant market in Europe and maybe in the world at the moment, coming down into major support, deeply oversold, and forming an upside weekly reversal. And that was the beginning of this rally in global stocks. Now, if you look to the right, bear in mind, commodities are very closely correlated with stocks. So these were posted on our website on October the 5th, October the 6th, about 2 weeks ago. Notice the collapse in the CRB index. We are testing at that particular point in time two very important support levels. One is the flat line, that purple line. That was the peak that was set at the beginning of 2010. And the other, the rising green line, is drawn under the lows of the last 2 years. So, and I didn't show it here, but commodities were also oversold. So we had important stock markets, foreign stock markets, bouncing off important support at the exact same time that commodities had reached very important support and were starting to show some signs of stabilization. The fact that both stocks and commodities were doing the exact same thing at the exact same time was an indication that some kind of a bottom was being put in and that both markets were due for some kind of a rally. So it just kind of shows how the two kind of fit together very nicely. Now, and also another very important part is to show how you can use traditional things like support levels and oversold levels and put a sort of an intermarket spin on it. Now, this chart is meant to put more of an intermarket spin. This CRB and stocks get an October boost from a falling dollar.
Here we can observe the chart on the left. And again, this was published in October. I can't even see the date. I think it's October 10th. You'll see the drop in the CRB index and the rise in the dollar. Almost a perfect inverse relationship. Notice the bottom in the CRB. Now, this was the following week. We saw that rebound at the important support line. So we're having a rebound and a correction in the dollar. So exactly at the point where the prices of these commodities are testing an important support, we have a correction in the dollar. Therefore, we're getting not only technical support, but also intermarket support. Let's continue.
So we're combining traditional technical work with intermarket work, and every market is doing exactly what it should be doing at this point. We have stocks and commodities in support and oversold. We have the dollar beginning to weaken, and we're getting simultaneous bounces in stocks and commodities. Everything's working exactly the way it should. And we have to bring bonds into the equation. This is the chart on the left there. Again, the commodity index, commodity CRB index. Actually, I'm using commodity ETF here, the DBC, which is a basket of commodities. And the green bars here, that's the bond market, the TLT, which is the long bond. These two are obviously very negatively correlated. Commodities and bonds normally move in opposite directions, and you can see the brown circle there to the left, the exact point where commodities started to bounce, bonds started to move down exactly. So if you're a bond trader and you see stocks and commodities testing support and starting to bounce together, it's not a bad time to take some profits. And the chart to the left simply shows, what does this show? This shows bond yields, which is the the green line, and the red bar that's got a little carried away with the colors here. That's the stock market, and you can see. Oh, yeah. Bear in mind that it's in stock prices and bond prices move in opposite directions. Bond yields move in the same direction. I've already mentioned that. So you could just simply see the bond yields and stocks falling together, and to the right there, over the last week or two, stocks have moved up and bond yields have started to move up as well. So we're combining all kinds of technical stuff with intermarket stuff, but every market is doing exactly what it should be doing. So the commodity.
In this part, I would like to indicate that we're combining all kinds of technical stuff with intermarket, that every market is doing exactly what it should be doing. So the commodity, the dollar's coming down, commodities are going up, stocks are going up, bond prices are coming down, bond yields are moving up, and they're all happening at important support levels. And of course, you can see the correlations along the bottom. I just put them in there to remind me whether when the correlations may be weakening or strengthening. So that's the basic message. Now let me just review some of these intermarket relations. I know some of you may be taking a test shortly on some of this stuff. I don't know what the questions are, but let me just review some of these. These are the relationships as I see them now.
In opposite directions. That is the case right now. The dollar seems to become a safe haven whenever the markets are in trouble. I don't know how long that's going to last, but that is the case right now. Stocks in the CRB are moving very closely together. I don't know how long that will last. At different stages of the business cycle, they do tend to move together, but at peaks, for example, stocks tend to peak before commodities, and at bottoms, stocks tend to peak before commodities. But for now, at least, they are moving very closely together. Bonds move in the opposite direction of stocks in the CRB. Bond yields and stocks are moving together. And that is, if you understand those relationships, I don't know if it'll help you or hurt you on the test, but at least it does. It will at least explain to you what's going on in the current market. And as I mentioned, if you can incorporate these things into your traditional work, I think it adds a new insight into what you're doing. And just to kind of wrap it up here, what intermarket analysis does, why I've become such a big fan of it. First of all, in my view, it bridges the gap between economic, fundamental, and technical analysis. As you know, there's always been a chasm between those three areas. But even though we're using price charts and we're using a lot of technical principles, virtually everything we've shown here today is basic fundamental and economic analysis. I don't know if any economist or any market analyst, fundamental, looking at any of this would disagree with any of this, because it's all based on sound economic principles. So I think it bridges the gap between those three areas and shows how they can be blended. And I think it helps move technical analysis into the financial mainstream. It's kind of unfortunate, it seems to me, having worked in the media, that the media, especially the print and TV media, the only reason they want to talk to a technical analyst is to talk about trend lines and head and shoulders tops, and they think that's all we can talk about. By being able to talk about inflation, deflation, interest rates, the fact that a technical analyst can talk about those things, I think helps move technical analysis more into the mainstream. And I think it broadens the appeal of technical work. And finally, it adds a new dimension to traditional technical analysis. As I've said many times, intermarket work doesn't produce any threat to technical analysis, and it certainly isn't meant to replace technical analysis. It just suggests that for those of you or those of us who do traditional technical analysis and really depend on that for our work, by being aware of how different markets interrelate with each other, how they impact on one another, and how they lead one another, I think it adds a very important new dimension to traditional technical analysis. And so that's what this is all about. And as I mentioned, the new normal, those are the changes that we see now. Some of them have changed from some of the traditional relationships. And of course, one of the things we're always looking for is some signs that some of them may be changing again. But right now, The new normal that I described today are the ones that I'm using in my current analysis. And anyway, you might want to take a look at that as well.
I hope you enjoyed it, and most importantly, that you understood it so you can make the most of the information I've acquired throughout my long career. May you pass all of this on to the new generations that are already in, and those who are arriving in this fantastic group that is the financial market. My legacy and my knowledge are all there, within reach of anyone who is interested. Thank you all again. Take care. Bye.